everyone, this is Group 12. Our group gonna present you about Chapter 12 or Depreciation Methods. Our group members include first, Parina Tantitamrongwood, second, Palapana Kyo, third and last, Thanatat Kunaneksen. Our table of contents, we have 6 chapters here. First chapter is about depreciation terminology. Second, straight line SL depreciation. Chapter 3, declining balance depreciation. Chapter 4, modify accelerated cost recovery system or MACRS. Chapter 5 is 2 more depreciation methods. Chapter 6 is switching between classical methods relation to MACRS rate depletion methods. First, Chapter 1 about depreciation terminology. Depreciation is the decrease of a tangible asset's value over time. The depreciation technique is a way to account for the asset's reducing value to the owner as well as the diminishing worth of the capital funds invested in it. The annual depreciation amount is not an actual cash flow, and it does not always represent the asset's real usage pattern during ownership. The depreciation methods we shall discuss in this chapter can be used for 2 different purposes. First, book depreciation use a company or a business to track the value of an asset or property over time for internal financial accounting. Second is tax depreciation. A company or business can use it to calculate out how much tax they owe, depending on the government's current tax policy, country, state, province, etc. Even though depreciation is not a cash flow by itself, the amount of tax depreciation is a deductible factor when calculating annual income taxes for the company or organization. It might result in actual cash flow changes. The common terms used in depreciation are explained here. A. Adjusted cost basis is the asset initial cost basis adjusted for permitted increases and decreases used to determine depreciation deductions. B. First cost or cost basis is the asset's unadjusted cost basis. It is the cost of purchasing an asset for the first time. C. Book value is the property initial cost basis, adjusted for any changes less all applicable depreciation deductions. D. Market value is the amount paid to a willing seller by a willing buyer of an asset. E. Salvage value is a property's expected value at the end of its useful life. F. Recovery period is the number of years of an asset recovery. G. Usual life is the anticipated period of a property's life. Our next chapter is Chapter 2 about straight line SL depreciation. The value of an asset is decreased consistently throughout each period with the straight line depreciation method until it reaches its salvage value. For distributing the cost of a capital asset, straight line depreciation is the most simple and effective technique. The annual SL depreciation is determined by multiplying the first cost minus the salvage value by dt. In equation form, dt equal to b minus s multiplied by dt. Here, and is equal to b minus s over n, where t equal to year. Example is t equal to 1, 2, 3, and so on, or n. dt is an annual depreciation charge. B is first cost or an adjusted basis. S is an estimated salvage value. N is for recovery period. dt is for depreciation rate, which is equal to 1 over n. Since the asset is depreciated by the same amount each year, the book value after T years of service, denoted by BVT, will be equal to the first cost B minus the annual depreciation times T. Here is the formula. BVT equal to B minus T times dt. The format for the spreadsheet functions to display the annual depreciation dt in a single cell operation is equal to SLN and BSN. For example, this is our example. A machine has an initial cost of 50,000 and a salvage value of 10,000 after 10 years. Calculate the book value after 5 years and plot the book value of the asset after each year using straight line depreciation. Here is a solution. First, we set annual depreciation, which is formula is D equal to B minus S over N. Since our B is 50,000 and our S is 10,000, and we divided by our years, which is 10 or N, we got the value of 4,000. The book value after 5 years, which the formula is B V1 equal to B minus T dt. Again, since our B is 50,000 and our T is 1, so 50,000 minus 1 multiplied by our dt, which we have solved before, which is 4,000, and then we got the value of BV1 is equal to 46,000. Next, we're going to calculate for BVS. Since the formula is the same, so our B is 50,000 minus our T changed to 5 years and multiplied by our dt, which is 4,000. Then we calculate it and got the value of 30,000. Here is our graph from our solution. And here is our spreadsheet function to display the annual depreciation dt. So our next chapter is chapter 3, declining balance depreciation. The annual cost of depreciation is a fixed percentage or constant proportion of the book value or salvage value at the start of the year. According to the fixed percentage approach, the annual depreciation expenses, which vary from year to year, are highest in the first year and lowest in the last year of the property's life. It should be noted that a property may never deteriorate to zero value using this strategy. Annual depreciation is calculated by multiplying the book value at the start of the year by a fixed or uniform percentage D, represented in decimal form. The maximum annual depreciation rate for the DB method is twice the straight line rate, that is, D max equal to 2 over N. In this case, the method is called double declining balance or DDB. If N equal to 10 years, the DDB rate is 2 over 10 or 0.2. So the 20% of the book value is removed annually. Another commonly used percentage for the DB method is 150% of the SL rate, where D is equal to 1.5 over N. The depreciation for year T is the fixed rate D times the book value at the end of the previous year, which dt equal to D multiplied by BVT minus 1. The actual depreciation rate for each year T relative to the basis B is dt equal to D multiplied by 1 minus D and then powered by T minus 1. If BVT minus 1 is not known, the depreciation in year T can be calculated using B and D, which dt equal to dB multiplied by 1 minus d, and close the blanket, and powered by t minus 1. And the book value determined in either of two ways. The first way is BVT equal to B multiplied by 1 minus d powered by t. The second way is BVT equal to BVT minus 1 minus dt. The implied salvage value after n year is the BVN amount. That is, implied S equal to BVN equal to B multiplied by 1 minus d powered by n. The estimated S value is not considered in the dB or DDB methods to compute annual depreciation if a salvage value is estimated for the assets. However, if the suggested S is more than the estimated S, if the fixed percentage D is not stated, it is possible to determine an implied fixed rate using the estimated S value. If S more than 0, the range for D is 0, less than D, less than 2 over n. Implied D is equal to 1 minus S over B powered by 1 over n. Spreadsheet function equal to DDB and BSNTD, or equal to DB BSNT. So, for our example for chapter 3, example, underwater electroacoustic transducer were purchased for use in sonar applications. The equipment will be DDB depreciated over an expected life of 12 years. There is a first cost of $25,000 and an estimated salvage of $25,000. A. Calculate the depreciation and book value for years 1 and 4. Write the spreadsheet functions to display depreciation for years 1 and 4. B. Calculate the implied salvage value after 12 years. Okay, so we're gonna do the first one first, which we have to find DDB fixed depreciation rate, which the formula is D equal to 2 over n, which our n is 12, so it's 2 over 12, which is equal to 0.167 per year. For year 1, D1 equal to DB multiplied by 1 minus D over powered by 1 minus 1 is equal to our DB here 0.167 multiplied by $25,000, which is our B, and then multiplied by 1 minus our D, 0.167 over powered by 1 minus 1, which equal to 4,175. For BV1 is equal to $25,000 multiplied by 1 minus 0.167 powered by 1, which equal to 20,825. For year 4, D4 equal to 0.167 multiplied by our B, which is $25,000, and then multiplied by 1 minus 0.167 or our D, and then powered by 4 minus 1, which equal to 2,413.19. For BV4 is equal to $25,000 multiplied by 1 minus 0.167 powered by 4, which gives us the value of 12,037.049. And then we have to imply S after 12 years. The implied S is, the formula is BVN equals to B multiplied by 1 minus D powered by n, which equal to 25,000 multiplied by 1 minus 0.167 powered by 12, which gives us the value of 2790.487. For the next example, Freeport McMoran Copper and Gold has purchased a new ore grading unit for $80,000. The unit has an anticipated life of 10 years and a salvage value of $10,000. Use the DB and DDB methods to compare the schedule of depreciation and book values for each year solved by hand and by spreadsheet. Okay, solution, we have to imply DB rate. To find D, we have formula of D equal to 1 minus S over B powered by 1 over N. D equal to 1 minus, since our S is $10,000 and our B is $80,000, so minus by 10,000 over 80,000, and then powered by 1 over 10. Give us the value of 0.188. And then we have to check. 0.188 is less than 2 over n equal to 0.2. So it does not exceed 0.2. We have to check because it does not state fixed percentage D. For t equal to 2 from the spreadsheet, D2 equal to D multiplied by BB1 equal to 0.188 multiplied by 64,984, which gives us the value of 12,216.992. For BB2 equal to 64,984 minus 12,216.992 equal to 52,767.008. Here. That's all.
Modify Accelerate Cost Recovery System, or MACRS. MACRS depreciation is the tax depreciation system that is currently employed in the United States. MACRS serves as the most suitable depreciation method for the tax purpose. The advantage of the MACRS: an asset may be fully depreciated before the end of its service life. A zero salvage value is assumed, and table make the system simple to apply. This slide shows the depreciation rate DT applied to the basis B for the MACRS method. This is shown on the 3, 5, 7, 10, 15, and 20 years. This slide shows the annual depreciation can be calculated by the depreciation rate multiplied by the first cost, and the book value in year T is determined by the subtracting the depreciation amount from the previous book value years, or by subtracting the total depreciation from the first cost. Chevron Phillips Chemical Company in Baytown, Texas acquired new equipment for its polyethylene processing line. This chemical is a resin used in the plastic pipe, retail bag, blow molding, and injection molding. The equipment has an unadjusted basis of B equal to $400,000, a life of only 3 years, and a salvage value of 5% of B. The chief engineer asked the finance director to provide an analysis of the difference between the DDB method, which is the internal book depreciation and book value method used at the plant, and the required MACRS tax depreciation and its book value. He is especially curious about the difference after 2 years of the service for this short life but expensive assets. Use hand and spreadsheet solution to do the following. A. Determine which method offers the larger total depreciation after 2 years. B. Determine the book value for each method after 2 years and at the end of the recovery period. Solution: B is equal to 400,000 and S is 5% of B, so it's equal to 20,000. The MACRS N is equal to 3. DDB depreciation rate back is equal to 2 divided by 3, so it equal to 0.667. In part A, MACRS depreciation from year 1 and year 2 can be calculated by this equation and this equation, and it gives depreciation in year 1 is equal to 133,320, and year 2 is give 177,800. So V plus D1 and D2 together, and it gives 311,120. From the DDB, depreciation can be calculated by this equation and this equation. It gives 266,800 and 88,844.4 in year 2. V plus D1 and D2 together and give 355,644.4 in DDB. So we can conclude that the DDB depreciation is larger than the MACRS. In part B, after 2 years, we calculate the MACRS book value in 2 years. So it gives from this equation book value in year 1 and book value in year 2, and it gives 88,800. And DDB, we calculate the after year 2, so it gives to 20,000. So DDB is less than the MACRS almost 50% for after 2 years. At the end of the recovery, MACRS give the zero value from this equation from B, book value year 4, and DDB give the 20,000. And this slide it show the spreadsheet calculation. 2 more depreciation method. Unit of the production depreciation method or UOP, based on the total number of hour used or the total number of units to be produced by using the assets over its useful life. Depreciation charge for each year T can be calculated by the actual usage for year T divide by the total lifetime usage and multiply by the basis subtract by the salvage. Sum of the year digits depreciation method or SYD over the earlier accelerate write-off model when compared to the SL depreciation. A higher expense is incurred in the early years and a lower expense is later years of the asset's useful life. The sum of the digit from 1 to n or SUM. SUM is equal to n multiplied by n plus 1 divided by 2. And depreciation charge for each year T equal to depreciable years remaining divided by sum of year digit multiplied by the basis subtract by the salvage. Actually, contractor purchased an 80,000 mixer for use during the next 10 years for contract work on IH-10 in San Antonio. The mixer will have a negligible salvage value after 10 years, and the total amount of material to process is estimated at 2 million cubic meter. Use the actual usage per year shown in Table 16A/1. And the unit of production method to determine annual depreciation. This is the solution of the UOP method. From the table, these 2 columns is given, and annual depreciation DT can be calculated by actual usage for year T divided by total lifetime multiplied by the basis subtract by its salvage. For example, in year 1, D1 is equal to 400 from actual usage and divided by 2000 is the total lifetime usage. Multiply by basis and subtract by the salvage, so it gives 80,000. So D1 is equal to 16,000. And we calculate all the column. So it gives 16,000 in year 1. From year 2 to year 8 it gives 8,000, and from year 9 to year 10 it gives 4,000, and total is give 80,000. Example of SYD method. Calculate the SYD depreciation charge for year 2 for the electro-optic equipment with B is equal to 20,000 and S is equal to 4,000 and at 8-year recovery period. First, find the sum. Sum is equal to n multiplied by n plus 1 divided by 2 and it gives 36. The depreciation charge dt is equal to n subtract by t plus 1 and divided by sum multiplied by basis subtract by the salvage. So it gives 4083.34.
For Chapter 6, Switching between classical methods relation to MACRS rates. Switching between depreciation technique might help you reduce the book value faster over the recovery period. It also optimizes the present value of cumulative and total depreciation. As a result, moving frequently boosts the tax benefit in years with higher depreciation. The techniques outlined below is a built-in feature of MACRS. The most typical move is for a DB method to add SL method, since it usually provides a significant benefit, especially if the DB method is DDB. The general switching rules are summarized below. DB method to SL method usually work best, and the relation to maximize is provided below in the slide. The general rules for switching between two methods, there are 4 main rules. The first one is when the present method depreciation for year T is less than the new method, switching is suggested. The depreciation DT that has been chosen is the bigger amount. The second is can switch only one time during recovery period. The third is the estimated salvage value must be lower than the book value. When moving from a DB method, the estimated salvage value is utilized to determine the depreciation for the new method, not the DB implied salvage value. We assume S equal to 0 in all circumstances. And the last one is the under depreciated amount, that is BBT. It used as the new adjusted basis to select the larger DT for the next switching decision. Next is the procedure to switch from DDB to SL depreciation. For the first one, for each year T, compute the 2 depreciation charges. Next, select the largest depreciation value. The formula is provided in the slide, as you can see. And for VDB or variable declining balance, this means the depreciation for 1 year or the total over several years for the DB to SL switch. The function format is provided below in the slide. For the example of SYD method, the Outback Steakhouse main office has purchased $100,000 online document imaging system with an estimated useful life of 8 years and a tax depreciation recovery period of 5 years. Compare the present worth of total depreciation for A. The SL method, B. The DDB method, C. DDP to SL switching method, and D. Perform the DDB to SL switching using a spreadsheet and plot the book value user rate of I equal to 15% per year. The first one, A. The SL method. So we have to find the annual SL depreciation by the formula here. So we plug in the value, so the result is 20,000. And as we notice, SL is the linear, so we can use PA replace PF to find PWD. So here is the formula for find the PWD. So Here we open the table and we got this number 80.3522 multiplied with 20,000. So the result is 67,044 here for the SL method. Next, for the DDB method, so D is equal to 2 divided by n, and we know that our n is 5, so we multiply we divided 2 by 5, so equal to 0.4. And in the table, so we can find the dt by this formula. And for example, for year 2 is equal to d2 equal to 0.4 multiplied by 100,000 and multiplied by 1 minus 0.4 power 2 minus 1, so the result is 24,000. So we use this formula for this rule. And when we got the PWD value, so we know that PWD value for the DDB method is equal to 69,915 by DDT, and the by SL method is 67,044. So we can conclude that the accelerated depreciation of DDB increase PWD. Next is use DDB to SL switching method. First one, use GT from the question B and find DSL. The DSL formula is given here, so we just example year 2 and year 4. We plug in the value here for year 2 and we got 15,000. And for year 4, we plug in the formula here and we got 10,800. And from column larger DT here, switch in year 4 with D4 is equal to 10,800 and DSL is equal to 12,960 in year 5, but currently it's switched in year 5. And so the total depreciation switching is 100,000 compared to DDB of 92,224. And T with switching method, PWD is equal to 73,943, which increase over DDB and SL. So which means the switching method is better than the other. And this is spreadsheet calculation. Here is from the spreadsheet, and we provide a graph here, so as you can see with here the year 4 and year 5 is a little bit different here. For chapter 7, depreciation methods. Depreciation is a non-cash book method of representing a natural resource's declining value as it is recovered, removed, or fallen. Oils, minerals, and timber are just a few examples. The taxable income of a firm is reduced as a result of depreciation. There are two types of depreciation procedure now available. The first one is cost depreciation and the second is percentage depreciation. Depreciation of resources cost depreciation, also known as factor depreciation, is based on the degree of activity or utilization rather than times. As with depreciation, most forms of natural resources can be subjected to cost depreciation, and timber production is no exception. The cost depreciation factor, or CDT, for year T is the ratio of the resources' initial cost to the expected number of units recoverable. And you can see from the slide, the formula is given below. And from this formula, you have to know that the total cost depreciation cannot exceed the first cost of the resource. For the percentage depreciation, depreciation as a percentage natural resources are given special considerable in this way. Each year, a certain amount of the resource gross income may be depleted as long as it does not exceed 50% of the company's taxable income. The quantity of depreciation during year T is computed as follows, as you can see in the formula from the slide. Using percentage depreciation, total depreciation charges may exceed the first cost with no limitation. The annual percentage depreciation rate for some common natural deposits are listed below per U.S. tax law, and you can see in the table below. In the first example of cost depreciation, Temple Inland Corporation had negotiated the right to cut timber on privately held forest acre for $70,000 and estimated 350 million board feet of lumber is harvestable. For A, determine the depreciation amount for the first 2 years if 50 million and 22 million board feet are removed. B. After 2 years, the total recoverable board feet was re-estimated upward to be 450 million from the time the right were purchased. Compute the new cost depreciation factor 40 years later. Okay. For the solution of A, so the first one we have to find CDT first, and CDT formula is given, which are first cost divided by resource capacity. So we just plug in the value of first cost, which is 70,000, and divided by resource capacity, which is 350, and the result is 2,000 per million board feet. And then we have to obtain year one. Year one, we can find year one by multiply 2,000 by 15 million board feet, so the result is 300 repeated. And next we have to obtain year two. 2,000 multiplied by 22 million board feet, so the result is 4,400 repeated. Solution of B is we have to find the total amount of depleted after 2 years. So we combine 300 with 4,400, so the result is 7,400 that had been depleted. Next we have to find the remaining investment, that our first cost is 70,000 and minus with 7,400, so the result is 626,000 investment remain. Next we have to find the remaining of the board fees, and from the problem given 450, and then we minus with 15 and minus 22, so the result is 413 million board feet. So we can find new CDT by the same formula, which are 626,000 divided by 415. So the result is 1,516 per million board feet. Here, either. The next example for percentage depreciation. A gold mine was purchased for $10 million. It has an anticipated gross income of $5 million per year for year 1 to 5 and $3 million per year after year 5. So assume that depreciation charges do not exceed 50% of taxable income. Compute annual depreciation amount for the mine. How long will it take to recover the initial investment at I equal to 0%? So the solution is the rate for gold is PD equal to 0.15, as you can see from the table here. And so year 1 to 5, we multiply the PD with the 5 million, so the result is 75,000, and the year after that we multiply TD with 3 million, so the result is 45,000. So in 5 years we multiply 5 with this number, so the result is 375,000 is written off, and the remaining is 10 million minus with 375,000, so you will get this number here, and this number is written off at 45,000 per year. So we can get the year that the initial investment could be fully depleted by 5 plus 625,000 divided by 45,000. So the result is 18.9, but we up the number, so the answer is in 19 years the initial investment could be fully depleted. And this is the end of our presentation. Thank you for watching. Goodbye.